Hey, can you hear me?
Oh, can you hear me?
Hey, Andy.
How are you doing?
Good, good. How are you?
Yeah, doing pretty good. Like the FOMC. And just having a tough time balancing out the balance sheet for Tesla. I think I narrowed it down to the debt.
Um,
But
well, if it's the debt, then I recommend unlinking it first. Like just like
okay.
just plug in a number.
I think the debt part, why I think it's tricky is they combine the operating liabilities with debt. And then when they combine that, I have to strip them apart in my debt schedule. Um, but then it's when I put it back, it just somehow just not adding up. I guess that's the issue. So I'm looking at my Rivians and the Lucid. It's pretty straightforward because they break it apart. Oh,
Yes.
when you say you wanna like in the debt, you just plug in the numbers. What do you mean? Like,
So there's two problems with the debt sweep or like any kind of debt analysis. I guess the one that you're talking about is a little easier, but normally when I build out a debt model, the debt schedule, I'm also
mhm,
incorporating the debt sweep and the cash sweep. And so what happens is in the income statement, the net interest income is a function of the debt schedule and the debt sweep that I put together. So when I think
mhm,
about a debt model, I think about those three things: a debt schedule, the debt sweep, the cash sweep, and then their impact on the balance sheet from a cash standpoint and also on the income statement. So
mhm.
there's often a circular reference issue that happens. It's a notorious issue. So typically you should delete the reference first, um, create another line item for the number, and then relate that number to the income statement. And then typically the model will flow. And once you have the model flowing, everything is matching, then you can try to relink it again. And typically you have to make sure that your Excel has iterative calculations and you have to hit like F8 to let it update. Um, that
I
doesn't
actually
always
had that
happen though.
solved for the interest income and interest. I think I set it up the same with you. You know, the debt schedule and the cash model is together.
Okay.
Um, and then I solved the interest income and expense by referencing to prior quarters ending balance. So my interest calculations based on the prior quarters.
Good.
Instead of the
Yes.
average, I try to do the average, but somehow still is a circular reference.
It
So
is that is a circular reference, and that's okay. That you actually want that circular reference, and you can make it work. You just have to allow Excel to iterate a couple of times.
right.
But I don't recommend. Yeah, I don't recommend doing it for our intents and purposes. Like if you were doing like an LBO model, then yeah, you need that. But I think for in our case, you don't need that. Or there's also another thing that you could do, which is you could look to see what's the percentage of net interest expense as a percentage of like their debt, for example.
Right.
Um, and that is another way that you can approximate what that interest expense is going to look like.
Mhm.
But I
And
think what you're saying
well, my
is,
issue actually is on the debt repayment.
oh, okay, then that's easy.
Oh, really?
It,
Okay. So it's
yeah, yeah, that
debt repayment and the current debt and finance leases, long-term debt and finance leases, and how these things tie together in the cash flow statement and the balance sheet. So that's what I'm stuck on.
okay. Do you know what is Do you know what the number is? Like you see what the number is? Like you've gotten it down to the number or not yet?
Like what number are you referencing to? Like
When you
which?
look at your balance sheet check,
Uh, yes.
do you like know what that number is?
I I don't know what that number is.
Okay, you don't know what the number is. Okay. So you're
I
not
don't know.
there yet. Okay, you're not there yet.
I can let me share my screen. It'll be easier. I promise this won't be too long. It's just so you can see like everything else is the same
Scroll
after.
in on this. Let me see. And which side is
So
heavier, the asset or
so
asset or LD side?
on the current fiscal year, the right hand side, the equity and liability
Okay.
is more,
So it's by
but in the
474.
yeah, but in the future it's the other way around. However, because it's so consistent, I think I'm like very close to solving it. Like there's only one issue because
Okay.
it's like everything's the same afterwards.
So
Um,
uh go to total liabilities and equity, hit F2, row 468. Yeah, hit F2. Okay. Um,
so I think why I have the issue is when I have the desk week. Okay, I think I need the more lessons on the desk schedule because
okay.
like this part is what I created for Tesla only, and this debt I grabbed from their 10K on the debt section. And the mandatory repay, I don't know like the unamortized cost and how that will tie in here because now we have the mandatory debt repayment.
Right.
Because on each of the years they give out the numbers. So these number on top I grab from 10K. Um, actually like here I grabbed these from 10K. Because they actually tell you what's the current debt versus the current debt finance leases versus long-term debt finance leases. So I actually break it apart, which I just took the number works out, it all adds up. But when I'm doing forward looking calculations, I'm a little bit confused on how I put these things back together because I remember on our previous models we just used a factor to grow the debt and finance leases, and then that's easy, right? If you grow it by just a factor, then cash flow statement you have another counterbalancing line and it will counterbalance. Like that's okay, but like here when I have two things mashed together and I think that's causing quite a lot of issues.
Okay. Well, so just a quick thing, which is don't okay, so your debt,
Yeah.
that's right. Your total debt, are you like forecasting what you think that is gonna look like in the future? No,
Yeah.
you're not. You're not. You're doing it right. So
I mean,
what's the difference between debt and total debt?
uh, okay. Like you mean this and this, like these
Right.
two?
Yeah.
Yeah. So total debt is just current debt plus long-term debt.
Okay. Okay. That makes sense. Do you have to break it out like that?
Uh,
Because you're modeling something into the future.
yeah. So the issue is in their balance sheet. Um, like they do it like this, which is super annoying. Like they have current portion of debt and finance leases, and then net or current portions.
Okay.
So it's either I can just take these numbers and then treat like this is kind of my question is coming from. Like when you're doing the long term, like the debt schedule, are you including the current debt as well? I think in our old model we didn't include that. We
So
just did
when
it
you're
on
doing
long
the
term debt.
yeah, so the current portion, so it depends on what's on their statement, but whatever is listed as the current portion, is going to be reconciled through the cash flow statement.
Right. So what? Wait. The current is gonna be reconciled, not the entire debt.
I mean, the entire debt is going to get impacted in the debt schedule, right?
Yeah. Oh, wait. Okay. So in the cash flow statement, when I have this, where is it?
Should be below. Should be in the CFI from financing
CFI.
activities.
Like you mean the
Lower.
wait, no, lower. The repayment of debt. Yeah, I have that
Yes.
model then.
Okay.
I have that model, and this number is exactly what I have down below for the repayment of debt
Wait, where's your repayment of debt?
in the debt schedule.
Oh, okay. Okay, got it. Okay. So is that the same number as current portion?
No.
Okay, that needs to be the same number as current portion. That's current portion.
Okay. Well, one sec. In the mandatory debt repayment, these two numbers come from the cash flow statement. That's what they already paid. 1978 is something that's due this year under 10K.
Right.
This number is a little bit different from what they have on the current. Like the wait. Hang on, one sec. Sorry. It's a little bit different from this number.
Okay. Yeah. That's fine. You're never going to reconcile. Look, today's cash flow
The current
statement is
debt.
never going to reconcile perfectly.
Okay.
So what we're just saying in the future, right? When we're modeling out in the future, they need to match.
Okay, so that means this
But
number.
you also have to remember that current portion, the balance sheet, that's an annualized rate, right? Like it's an annual like number, right?
It's an annual like BF12.
Right. Well, no. It's not BF12. It's more like LTM in that sense.
LTM.
So
Okay.
yeah. So the change in current portion, is gonna is gonna be the same as the change in your debt repayments.
Yes.
So like, okay,
Okay.
I'm like, let's break this down, okay? So for 2024, the last quarter that they reported
Yeah.
was Q2, and they said that their
Yeah.
current portion is 2264.
2024 for the debt.
2024, okay?
Yeah.
So this means that at the end of this year, that's the amount that's going to get paid out.
At the end of the year.
Right.
Okay.
So at the end of the year, in 2024, okay, it's going to equal to whatever that number is. And any of the difference in the quarters has to do with either the actual payment of the debt or the change in the value of the debt, the amortization of the debt, right?
Right.
So that, so that's just something to keep in mind. Okay.
Okay.
But what it means is that in column R, that should equal to the current portion. But when you're doing the current portion, your mandatory debt, repayments, you need to do the run rate for what that would be. Are they actually, if you look at what happened in Q1, they paid 302.
Yeah.
And in Q2, did they pay 920?
Yeah, that's from the
went
cash
out?
flow statement.
Okay, and the cash flow statement, is that your adjusted cash flow statement, or is that in the reported cash flow statement?
In the reported cash flow statement.
So the reported cash flow statement, what's the problem with the reported cash flow statement? It's year to date.
Oh,
So it's double counting.
No, this is adjusted.
Adjusted? Okay, cool.
The actual, the reported is way higher. Like 1222. So I did 1222 minus 302.
Okay,
This is like, oh, I see what you mean by like, reported versus adjusted. Yeah, everything adjusted here.
Okay, great. So your current portion, right, is gonna at the end of the year, right, you're gonna pay off the entire current portion for the current portion of this year. So
this year.
the rest of the 2 quarters should be equal to whatever is the remaining balance.
Right. So like 1978 is on the last 10K. It shouldn't be this number. It should be this. Oh, sorry, this. The 2024.
For current portion. That's the
Yeah, so
current portion as of Q2. Yeah, that's the current
Q2.
portion, right? And then in
Yes.
Q3 should be Q2 minus the amount paid out, right? And then Q4 should be the balance of whatever is left. But but the full 4 quarters, like at the end of the period, now this is for this year's, payments. Yeah, it should all have been paid.
Okay. Okay.
Now I want to make clear that why would, like last year in 2023, current portion
Mm-hmm.
of debt went from a billion to 1.97 billion. Okay.
Yeah.
So what's happening there? Well, one is it's combining the payments made to cover the debt plus debt that's doable. Maybe they issued a bunch of debt that's due that year, right? Like within the
Mm-hmm.
year. And so that would be
Mm-hmm.
added to the current portion as well.
Okay.
So when you
So
think about the tranche, right?
uh,
So I mean, do you know what that bond is? Like, do you know what that amount is?
I actually don't know. I need to
Okay.
check.
So I would look at the debt schedule on the 10K because that will tell you when all the payments are due. It'll say, oh, for this
Right.
bond, it's just they're just gonna pay like, $100 or like $100 million a year in interest for 5 years, and then it's gonna be paid in 2025. So
Okay.
the payment, like when the payment's gonna happen, there's no impact to current portion until 2025. Okay, until that date.
Mm-hmm. Mm-hmm. Okay. So let me where let me show you where I got my data from. Um,
Okay. I mean, I'm happy to also, like, we can do a deep dive
yeah, we
together
can do it.
because
Sure.
yeah. But what you're gonna want to
Ah.
know is like what is the debt that's currently
Mm-hmm.
listed there? Like, what's the
Mm-hmm.
breakdown? Um,
Mm-hmm.
and that way you're gonna know because then when I build the tranches, I don't
Mm-hmm.
just do debt. I will do it by the tranche, like by the bond that is issued. You remember that we
Okay.
did this for Lucid. We actually
Yeah.
knew the exact bonds that they had, right?
Right.
Yeah, and
So
then
I was following Hamilton on this one. Just take the entire like take everything together sort of approach.
right, yeah.
Um.
You
Okay.
could do that too, but then the way that you will like figure it out is going to be a little different.
Right. Okay. Okay.
But
Yeah.
the way that I'm stating is just it's the cleanest, and it's
Mhm.
also what I'm used to, so it'll be the fastest to implement. I mean, the Hamilton,
Okay.
like a generic approach. Um, yeah, you would probably reconcile it by. I mean, the problem is that I don't know what the mix of short-term and long-term debt the current portion is comprising of.
Okay.
Current portion might include commercial paper and payments for long-term debt due this year. I just don't know what that is.
Can you see the
Yeah, yeah,
screen?
yeah. Go ahead and
Is
zoom
this
in.
something? Oh wait. Oops. Where did it go? Is this something you're looking for?
Yeah, exactly. That's exactly what it
Oh.
is.
Oh, sorry.
Yeah, you
Okay.
see over here
So
it says
just use
due in one
this.
year. Yeah, yeah. You see it?
Yeah.
That other table said due in one year. Yeah, they'll often give you a table that's like due in 1 year, due in five, due by year. They'll give you a table of like years and how much is due per year, but they'll also give you the
Hmm.
breakdown. So I know that there's that 2024 notes. Could you zoom in a little? It's a little small. So over here, for example, they've got those 2024 notes. They also have that credit agreement, and they have solar bonds. So those are recourse debt. And they have non-recourse debt. Those are automotive asset-backed notes.
Yeah,
You know,
all asset
cash.
backs. Okay.
Right. So that's going to give you a good idea. But scroll down.
This is 2022.
Right. Scroll down. I'll show you. There's a specific table that you're gonna.
Yeah,
That's the table.
I use this. I use this.
Okay.
Like
Good.
the number to pay off,
Uh-huh.
1978. That's why I put down for 2024.
Okay, so that number to pay off, that
Right.
is your current portion on the balance sheet. Okay, it always needs to equal that number.
Really?
You should not be
Wait.
generating current portion outside of that.
Please. Okay, I think yes, that might be the problem. So what we had here, 1975.
Uh-huh.
This
Don't do this retroactively though. You can only do it in the future.
Okay.
Just a
I
heads
can
up.
only do it for you. Okay. So I know like this year's current portion is going to be this.
Right. Exactly.
Okay. And then
and so
I see.
that's the mandatory debt repayment. And so you link the current portion to
minus whatever's being paid off in the first half is what's left. That should be my current liability on my balance sheet.
Yes, your debt line item.
Okay.
Yes.
I will tidy this up and see if it balances. I think it's very helpful. It's very helpful. Thank you.
Nice. No,
Cool,
I love getting into the details of these things.
Cool. It's like I want to like initiate on a new company, but it's just with the balance sheet, it's just like I want to get it done before I move on.
Right. And honestly, the more practice you get on cash flow statement and balance sheet integrations, you know, I would almost say that, you know, what you could do right now, if you like really wanted to, is you could see like, okay, what's like the next wave of companies that you want to initiate on? And what you could do is you can go and build like a tier 2, like a really basic model for all of them right now, like an annual model.
Right.
And just do the annuals and then forecast the annuals for the next like 5 years. Do all the reconciliations and then just move on to the next company, right? Yeah. No revenue build, no anything else. Okay. Just put in the data, link everything up, and put like a dummy variable for the forecasts. Do that for your next tranche of covered companies. And then after that, when you do the initiation per company, then you can kind of do with the nuance. But you'll already have the structure in place.
Okay. Yeah. I'll start. Well, first of all, balance these things out, and then on Rivian Lucid, finish up the earnings preview, which is next week. So, and then we're good to go. I think I'm pretty confident on this earning as well for Lucid and Rivian. So I'm just like
exciting.
Like do some final scrubbing. There's not a lot of like writings coming out from sell side. Maybe it's not time yet. But yeah, on the topic of earnings, I'll bring it back to you.
Dude, today was such a nuts day, and I felt it was really tough too because I had a bunch of like operational calls that we had to take because we're moving Prime, so it's like, oh my god. But
Prime, FOMC, earnings.
A good thing that I'm really proud of is I was able to negotiate my stock, like the commission, like per share commission, like really to a really competitive price. The price that they first came up with was like
they always do that. They always do that.
Yeah, so
all the Prime people. Yeah.
Now the problem is, and they were able to get options out a little too, but the problem is that their futures pricing is like, it's gross. I was asking one of my a friend of mine, I was like, at your fund, like how much do you know how much you pay for futures? And he was like, yeah, we pay 12 cents all in. And I was like, you know what I'm quoted right now? $1.50.
What?
But here's the thing, like I'm not we're not a commodity pool operator. So we don't have high turnover or like a lot of trading on the future side. So it's like I get it that like we don't meet the turnover requirement that the prime would have to get to the thing. But I'm still like $1.50, like that's 10x. That's more than
I
10x.
know.
What
I know. I mean, I hope we got like better deals on like lockup agreements and all of that. That's
right,
like,
which
things that
is
you can negotiate. You're like, yeah, your
right.
future pricing is bad, but hey, better terms on lockup, better terms on the like the what is it called, like the maximum drawdown, like there's like a limit something when they pull liquidity. Those
Oh,
can
right,
all be negotiated.
right.
Yeah.
Yeah, so they actually came back really good on almost everything else, but the one
But
thing, the one area that they're screwing us on is on futures. And the
I can
guy's
live
like,
with
you know
that.
what,
Yeah.
like we'll discuss this as we see what your volumes look like. And I'm like, so I'm kind of like, okay, like, yeah, that's fine.
Yeah.
I'm not, I don't, we barely, touch futures, so that's fine. But
Right.
it was kind of funny that it was like that far out of range.
Uh-huh. And I was telling you about like 3 cents options yesterday. And you'd be like, oh,
Yeah.
yeah.
The
Okay.
3 cents are what
Uh,
you were getting,
3 cents
maybe.
is what I was giving.
That's what
I'm
you were
sorry.
giving.
No, wait. 3 cents what I'm getting from client, which is a rate I'm giving client. Right. The
But
money is what I'm receiving.
right, but
Yeah.
does that include the trader?
No.
Yeah, exactly. The trader's
No.
probably getting another seven or 8 cents.
Well, I mean, it's a bit off a spread, right?
Right. I guess.
Yeah.
Yeah.
So
It's a,
yeah, it's
that's
tough,
tough.
tough out there. Yeah.
Yeah.
Um.
3 cents for options.
mm, mm,
And that's just listed.
mm.
Interesting. And that was like the standard across all of your customers?
Like on like the most prestige, best customers out there. Yeah.
Okay. Well, what do you think is like what was like the midpoint then?
I mean, I I didn't even have some like these other people just don't trade. Like for
I guess
smaller
that's a
ones,
good
they
point.
don't trade that much, so like I don't pick them up. But
Okay.
but the bigger guys when they trade, it's like that. So yeah, not making tons of money. So I really want to go back to 2015 and do this job.
That's
It'll make it
what's
so much better.
what's so interesting is that I pretty much know for a fact that when like the intermarket spread or commission that's
Hmm.
paid is like 10 cents still.
Intermarket.
Yeah.
Hmm.
So when your trader calls a floor broker, they'll pay
Hmm.
them 10 cents.
Hmm. Maybe we're just bad at this and we're trying to win shares, you know.
No, I wonder if that's
But it's
if that's what it is.
may,
Like there's got to
well,
be some offset to that.
probably like are they still getting 10 cents like today?
Yeah, I'm saying today,
Like
yeah. And
today's
when I
rate.
when I talk
Okay.
to people like, yeah, it's like, yeah, 10 cents.
Hmm. Interesting. Okay.
But I'm
Yeah.
thinking the reason that might be like a little bit of an arb in the sense that the bank must be making like so that tells me like the bank must be making way more, right? But I think the way that the bank is making money there is by crossing.
Oh yeah, yeah. We cross tons of trades.
Yeah. And I mean
Yeah.
how so but the trader wins on the cross. Like you don't see crossing. That's just the trader.
No, they tell us the X,
They'll
right?
tell you, okay.
They tell me the X, and then like most of the time they'll be like, "Oh yeah, I can give out a better rate on this." Like better rate, not necessarily commission. Better rate on this because I do have an X. I'm like,
Uh-huh.
okay, and I also like advertise all of his X to clients as well.
Right. Hmm.
Yeah.
Interesting. I don't know.
Okay.
But like
Good
that
luck
seriously is making me
with the
think like
plan.
I got to get my fees down then because I'm, you know, uh,
I think
three
it also depends
cents.
on volume. Volume.
Yeah,
well.
I guess. What was like the average size that you were seeing? What was like a
Like
normal size?
a normal size coming to me will be like 500 to 2,000, 3,000
Contracts, okay.
contracts. Yeah.
Okay.
So that's
What was
like
the largest? What was the largest you've seen?
the largest I've seen. On the option side, I'll say around like 5K
Really? Contracts.
contracts. I think
Okay.
that's like one of the largest I see.
Okay,
Yeah,
interesting.
yeah. But like
I don't
normal,
want to brag, but I've seen some 100Ks. Like this was back in the day though. So I mean, I don't know how
yeah.
it's changed, but
It's yeah, like on my end, like I do more like OTC stuff.
right.
Like on the everyday trading side, people weren't that active. Yeah. Yeah, like
It's
there's
definitely
some vol
interesting.
trader there. There's definitely some vol trader out there, like just trading VIX.
Hmm.
Yeah.
Who was your guys's did you guys have a separate like index vol and single name vol guy, or was it just one guy?
It's separate desk.
Okay.
Like the trader in New York is separate.
Two
So
different
the
people.
two different people. Yeah, single names and index and uh like OTC, they're all separate. So you gotta like go into different Bloomberg chat and just hooting different people.
Right.
Um, yeah.
Interesting.
But
I'm still just
were
like
there were
pretty
tons of index level activities when I was there.
okay.
Few single names. Yeah. I
Did
guess
the
because from these bigger banks, sorry, not banks, bigger clients, they are looking for like index level hedges.
Mhm.
So probably that's the reason why I see mostly like index. Yeah,
Okay, so
I don't
you mainly saw index. Did you
mainly
see
sign
like
that.
ETF volume on indices? Like, do you see like people doing like Qs or like
Yeah.
okay.
Q Spice, IWM, HYG, all of those common.
So I got a question, like why would and I'm trying to understand this because like this is something that's been in the back of my mind too, because sometimes,
Mhm,
often actually to express like a macro view, I'm using SPY or IWM or Qs. And
yeah.
it's just because I'm used to doing that.
Hmm.
And I haven't actually gone back to say like why am I mean I have thought about it, but I've not like, you know, seriously like done the math to see what the difference is. I'll price like, oh, if I want to express a view on SPX option versus a SPY.
Hmm.
Why is there this prevalence of using the ETFs as the option base?
I think what like I never asked them this. But from my view is it's I think the liquidity. And on SPY, I think there's like the AM and PM options, right? So like there's
Mhm.
more things you can play with just around the market structure where you have single names a little bit trickier. And
Right.
yeah, so I think they were the first people to have like weeklies and um like more expiries, I think.
Right.
So I think that's why people are more keen to do those
To play on
things.
those. Right.
Yeah.
Okay.
Like on single names, you really have to like have a strong view for them to put on the option trade because most of the pods that I was trading with, they are like just long short equity. They don't trade like long short options.
Right.
So yeah, so that's probably why I don't see that flow. And for those people who only trade vol, yeah, they ask prices 10 or 20 times a day. Yeah, just
Right.
to pick out, trying to see some weakness in our pricing. Um, yeah, I think you told me the story, and I looked back. I was like, oh, that's what they're trying to do.
Yeah.
Yeah, so tons of butterflies on VIX, like straddles, like those mostly like basic option structures, they always like ask for price every day. So yeah, so those are the vol traders.
Nice. Shall we pivot to macro?
Yes. Wow,
what a day.
Yeah, what a day. I still think, like I said in the chat, every meeting is live now. He did the pivot back, although like in the beginning, like opening remarks wasn't as hawkish as I expected, but towards the end, he actually laid out two different scenarios, and that's when I think the situation is reversed, because before he was only saying we want to see more data, bring it back to 2%, and then we'll think about the move. But this time he actually said out loud, hey, you know what? The other scenario is the labor market weakens significantly, and then we need to act on it. So it's like, yeah, he's now giving out the options, and just from the tapering and hiking experience over the last cycle, I think this is what Powell is saying. Hey, the options open, everything's live, and then just be prepared. There's tons of questions asking about like the magnitude of hikes and like how many magnitude of cuts, 50 basis cuts, 25 basis cut, how many he's going to do this year. I think it's premature to ask him that, because I don't think he made up his mind yet. This like 2-month gap almost. So there's Jackson Hole, obviously. And little like maybe 2 more months of data that's coming along. So yeah, this I think for me the base case is September if nothing changes from here. It's like I want to say nothing changes. Like we are still on this labor market weakness trend, and then the inflation coming down trend. Like if we keep going on this route, then yeah, I think September is the first cut. Yeah, and just on the auto side, pretty big news from Stellantis. So they're cutting engineers. 1,200 engineers from 1,800 or 200. It's one of those numbers in my notes today. Like across Europe and US. So that's going to impact their future R&D. When they're doing that today, interestingly, their cheap EV launch of like a Citroen E, what is it called? Like it's like a small vehicle in Europe
Right.
that had problems, software bugs on e-powertrains. So that's not a good look on Stellantis. And GM canceled a 1 billion aluminum pouch deal with Yochon Chemicals. That stock is down 30% on the news. But again, people are canceling these orders. Like it actually forced them to, cancel orders, and they know there's going to be a penalty on that, right? So they say the legals are reviewing the document, but GM said, hey, actually, you know what? I think this is a way to go. Even though we're going to suffer in the beginning, but we're not spending 1 billion on aluminum. So those two news together tells me a very big weakness in the traditional OEM space, especially in US, and hence it might affect the NFP and unemployment and initial jobless claim data coming up. I think me and Yafan agreed more so in September. August, I don't think there's enough time to show the data, but in September that will surely come up. So here we go. Yeah.
Right.
What do you think about Powell?
Yeah, Feng, you want to go take a stab at this?
Yeah, let's probably just go through the day first. In the midnight we have BOJ. They raised for like 15 bips, cut their JGB buying schedule like by half. I think there was like originally 6 trillion. Let me see like what's the pace. they cut the buying from 6 trillion to 3 trillion, and like each quarter, like there will be like 400 billion less of buying. Let's see. Yeah, so basically I think Weta thinks the like what he calls like the virtuous like cycle between like wage to price. That virtuous cycle is like still working. Yeah, so like the plan is like okay, it's like from around 6 trillion per month to like 3 trillion per month at a rate of like 400 billion yen each quarter. Okay. All right. I think also BOJ has like starting to emphasize the influence of the exchange rate on the inflation. So like as we see, like the USD, the dollar yen has now is now trading at like 150. I think just like briefly went under like 150, but still like trading around 150 right now. So yeah, I think they're putting like more attention, or like they're paying more attention to the exchange rate. So I'm not sure like if they're gonna do anything about it. But anyway, like this month they did another intervention at around like 4 trillion yen. I mean, not 4 trillion yen, like it's dollar, I think. Let me see. But anyway, like today they have the intervention data, right? Latest month release. All right, so here it says like 5 trillion yen of like intervention in July. I mean, in July. And they have done like, let's see. Okay, June is clear. Yeah, May there's like another like 9 trillion yen of intervention. So already like they have done like almost like 15 trillion yen of intervention. So like to put yen at this like rate, and they're still like paying more attention to like the exchange rate. So I'm not sure like if they're gonna like keep doing this, but I think right now like the yen short, I think it's like being more pressured. I'll probably like get some like more positional data coming up tomorrow, but yeah, I mean like the yen move is like pretty huge. And like after like Wada finished like his conference, like we have like some geopolitical event making crude going up. I think by the end of the day, it went up like 5%. Yeah, so like I'm not sure like what's like the well, I mean, I'm not actually sure, but like this is actually like making the geopolitical vol. I mean, it's not like permeating into the equity vol right now, but it's like the situation has like coming like pretty much like escalated then probably like yesterday, and yeah, just like unfortunate development. I mean, I thought like we're kind of like working towards like some peace deal, but no. All right. Then like there's like a QRA. They're putting they're they're like keeping like the same amount of the issuance. I think just like I'm not sure like it's like due to the Stephen Moran's paper, or he's like publish. I mean his whatever his paper does. I mean, but like the T-bag starting to like today they discussed about like the bill issuance. And I think what I've read from like the T-bag like presentation from their slides, they're trying now to maintain a like a 20% of like bill issuance percentage. And it says like it's kind of like average this over like a period of time. So I think in the JPM like piece, they're saying right now they're expecting like the bill issuance to be around like 15 to 25%. So I mean, this is kind of like somehow like disagrees with the like the assumption of like the Stephen Moran's paper, whatever they call it, the ATI is. So I think like Treasury just thinks like we can kind of like be flexible about this bill issuance percentage. And they did mention like the like a larger like bill issuances yeah, is performing like a shock absorber. So I mean, yeah, I mean, so yeah, not too much like around there. I mean, I was not like watching the market at that point because like there's like so much happening during the midnight. So I mean, then we have like the FOMC. I think he started like the press conference like in a hawkish way. Like I think he mentioned if like the economy like stays strong, we will like maintain this like rate until like the economy starts to like deteriorate. But like then he become like more dovish, turning on the green light for like a September cut. I mean, also he kind of like denied like a 50 pips cut. Says like no 50 pips right now. So yeah, I mean just like my impression is like I think right now the Fed's attitude is more like a laissez-faire. Let's like let's just let's wait and see basically like if like the data comes in like weaker, we'll like act. But if data is still coming in like okay, then we'll just like keep the status quo and we're just like not gonna do anything. And like think the market, the equities, especially like the small caps, they rallied initially uh, to like 2310 on the futures, but like by the end of the day, it's just like reverse like 50 points in Russell. So I think just like overall, I think it's just like a mixed message. I mean, definitely like more dovish than like the scenario where I mean, it's like dovish more than like our hypothetical scenario, but I think it's. I mean, you can either say like it's kind of like a balanced communication. It's more like a mixed message. So yeah, I mean, also today like we had the ADP employment number. I kind of like look into like the details. Still like the information sector, like the information technology sector, is like showing like a decrease. I think this is like being ongoing for like several months, even with like a headline, like a very strong headline figure. And I think another major decline in employment is in the professional services. That sector has like printed like a very negative number. Um, and actually like dragging down like the ADP headline, I think by like 30K or so. So yeah, I mean, this is probably like something, I mean, nobody's like paying attention to this probably, but I mean, combined with like the Stellantis like layoffs and everything, I mean, there are just like many data just showing like there's like cracks in the labor market. So yeah, I mean, let's see like what tomorrow and like Friday brings. Initial claims, they might be just like still like keeping the same pace, but like think NFP is kind of like interesting. Um, yeah, and like at the end of the day, like 10 years already at like 4.03 or something. Wow, I mean, and just like the entire thing has like, I think today we have like bull flattening, I think, yes. Like the longer end is like down less than the belly, as well as like the 2 year. So very interesting. I mean, yeah, we'll just see like what more labor data tells us. But I think like today is just like Fed is like well, we'll just like wait and see and just act when it's necessary, because we still have like so much ammo like in the armory, like we're at like 5.3 right now, 5.25. I mean, if we really like need to cut, like we still have like a lot of room to cut. So I think that's probably like why they're not in a hurry. But I mean, yeah, I mean, I'm
Yeah,
just like I'm just kind of like worried about like the overflow of like the geopolitical like uncertainties. I mean, this is not a good development. No,
yeah, I
it's
think geopolitics always, it's always like tough because it's always like back of mind and then suddenly it runs forward, right? It's like very hard to
yeah.
predict,
I think like one thing is just like, I mean, especially like this region, like with like constant like just conflict. I mean, especially like this time, it's just like spreading to like Iran, Syria, like Lebanon, like just more countries get involved. I mean, eventually this will affect like the freight, like the oil cargoes. I mean, this will like, I mean, I'm not sure like how much inflation like shock it will cost, but I mean, I won't be surprised if like we got like another like one or two uh like higher than expected like inflation prints. Although I don't know like how lagging, like how long will it take to like actually show up in the figures, because I think in the past two like CPI prints, like the energy has like posted like a very large like
you can
increase.
analyze this on data stream.
Yeah.
So you can create a chart, load up CPI,
Okay.
load up oil prices, and
Right.
then you can then click on, there's like a button on the top and it'll run a regression. It'll tell you the output. And then in that window you'll be able to lead or lag, the
Right.
data. And from what I've seen, the strongest relationship is on like a 3-month basis.
Right. Okay. So
Now,
yeah, I mean, these are kind of like interesting dynamics, because I think labor market data from this month is still gonna be okay, but like next month might be just like pretty bad due to like all of these like layoffs and stuff. But like if it takes like 3 months to like show up, like the inflation will kind of like, yeah. So I mean, that is kind of like, it's really like intricate, I would say. Like the timing will be like really precise, and yeah, I don't think it's like a easy task to kind of like maneuver this like soft landing. I mean, hopefully
yeah,
they do, but yeah, it's kind of like tricky now.
I don't envy the Fed.
Right.
So just to kind of like, let's kind of think about through. I'm going to start off with just like, my just a short, recap of what happened today. So, when I look at what is the Fed doing, is the Fed move, is it, hawkish or dovish? I'm going to look at the language. I'm going to look at how the market was positioned before, how positioning has shifted into like the month or so beforehand. And then I'm going to look to see. I want to then understand, the language in the meeting, and then from there, I want to then make a prediction about where I think the market's gonna price something. So, going into this FOMC meeting, I had kind of laid out three paths that I thought, would be more likely. The first path is that the Fed cuts interest rates, which I thought was very, the likelihood was extremely small. But I thought that that would have been the Fed being in front of the curve. Um, then there was the option of the Fed, um, signaling no cuts, no cuts in July, but signaling the strong likelihood of a cut in September. And then the third option was the Fed signaling, no cut, or saying no cut in July, and also we're probably not going to cut in September. Okay, so it's very important to understand these three different scenarios and how they track. So in scenario one, if the Fed cut interest rates now, Well, the worst of the data hasn't, we've not really seen the data like fall materially. So if the Fed was being data dependent, there's no reason for them to cut interest rates today. Yes, the unemployment rate has moved up to 4.1%. Yes, retail sales, has looked like it's cooling. Yes, PMIs are soft, but GDP inflected higher last quarter. And if you look at the host of hard data, they're still broadly supportive of the economy. Okay, that's like an important, factor to think about. That the economy, at least looking backwards, still looks pretty strong. Okay. So the Fed here is, if they did a cut, then they would be speculating on what the trajectory of the economy is going to go through in the future. Then they would be speculating on a regime change in the economic growth profile, which I think is beyond the scope of traditionally what the Fed would typically do. The Fed is typically gonna track what they're seeing in the data, and that seems to be the case here, right? So there was never really a big chance of them doing a July cut, but that was in the card because we saw that economic surprise data has moved substantially lower. We saw that there is some weakness in the labor market. There's some chance that there's a lot of overstatements. Economic estimates are also very high, and so this was like kind of peak. I don't want to say frothiness, but like peak bullish, expectations on the economy. So, that's kind of like the balance there. Now, with the backdrop that the economy has done well on an LTM basis, on a backwards, looking basis, then the Fed had two other positions to have, which is, well, the data is not bad enough to make a decision today, but might it be bad enough to make a decision in September? Okay, September is a month and a half from, or almost 2 months from now, right? So the Fed will have plenty of time. They're going to get 3 new data points, at the very least, between now and then. 3 like key ones, right? CPI and non-farm, 2 non-farm payrolls, and I think 1 CPI. So maybe 2. So that is that's the setup that they have, right? And the Fed's language, has begun to kind of shift to state that balances are now two-sided, or sorry, that risks are now two-sided. So kind of going into the meeting, it was like, okay, well, now the other scenario is that the Fed is going to defer to September, and then they're going to give a cut then. And the question is, then if that's what you think is the path, then the question is the Fed going to communicate a cut today, or are they going to push back against cuts? And so my view going into this was the Fed is going to push. The fact that the Fed was not just going to not cut rates today. The Fed was going to then also potentially hint that it was going to, start to enter into a cutting cycle, but push back against greater than 2 cuts. Now, in the actual language that we saw today, the press release came in line with that, but I thought that Powell's the Q&A session, and I'm still going to go back through it again today because I was only reading the transcript because I was on calls, but it seemed to suggest, or he seemed to suggest, that we're now in this scenario where we're no longer in there could be no cuts or there could be 2 cuts regime. We're now in a regime where there could be 2 cuts or there could be more than 2 cuts regime. Okay, so where would you then pin probability of cuts by December? At that point, you would lift it from 2. And my view was, okay, SEP view was 2, so that's where it should be. And it was at 2.75 or so, or around 2.7 going into the meeting. And when he said that, when he described the outlook like that, now that shifts the regime to price. And now it's like, okay, well, now your base point is a 2.5 times cut. But also, now that we know that the Fed is going to make a decision in September, we can now think about, well, what is the data going to look like by September? And so, like, my view, for example, is that in August, the data is going to be like so, probably in line still. It's going to be in September where the data could show could show some I don't want to say material weakness, but would show some potential weakness, because that's when we'll see the August non-farm payrolls data. That should include, we're not just seeing like a small like seasonal downturn, but also in the latest data points we saw that there are 2 sources of additional declines in non-farm payroll, or 2 additional declines in job, or say in industries where jobs are still carrying or holding, that could disproportionately impact non-farm payrolls. And those 2 are the residential construction, workers, and also auto, employees in the auto sector. So in the JOLTS report, we actually saw that construction workers, for residential construction workers, that data point has fallen off a cliff. I mean, that's come down dramatically. I'll pull it up in a second. JOLTS construction. I think this is the data point. Yeah, so that number has fallen quite dramatically. Okay, and everyone was talking about a rebound in residential construction at the end of last year and the beginning of this year, and now we've seen that come down. And because home sales have been weaker and have been softer, this number is just going to continue to go lower. Like we're not at the bottom yet. This is going to go quite a bit lower. We're in a very different regime than we were in, about a year ago. And even though mortgage rates are going to come down, now because of what's happening in interest rates, that still is not going to lift construction for some time. And we'll know it, by the way, when building permits come back in line. So the other data point that we're going to need to pay attention to is building permits. I think I actually got the wrong data point. I think I have housing starts. Yeah. Building permits. Okay, so once this data point really begins to pick up, then we're going to start to see, a nice increase. And there's some lag. So there's going to be some, like, a couple of, I don't want to say a year, but like a good amount of times worth of lag between when building permits will start to rebound and when you'll see a positive impact on construction, on new housing starts, and then on construction employment. Remember, like big, developers, they have to get filed for a building permit. That can take 3, 6, 9 years for it to get through. So once they've actually gotten their building permit, it's then going to take them another 3, 6, 9, 12 months for them to actually start. So then you start to see housing starts. That's the next data point. So building permits and housing starts. And then when the housing is started, that's when the employment for residential construction begins to pick up. And then you have housing completion. And then ideally the construction workers move on to the next project. That's that building permits, are sustained, and there's a continuous, cycle that's going on. In an environment where we've had mortgage rates that were too elevated, inventory looks like a little imbalanced, then we could be in a period of there's still more weakness in the, for the housing sector, in the housing market. And based upon a commentary from the housing sector, that seems to be the case. But I'm not trying to really predict too far in advance here. I'm just saying that right now building permits are still quite low. And so we would need to see them rebound for us to have a view that we've seen the bottom in construction workers. And it is true that the last month's data point came in a little better than the prior month, but that's still not indicative that we're seeing a real rebound in home construction. So I would say let's see how this pans out. Though I would assume that there is a relationship, an inverse relationship between mortgage rates and building permits, right? When mortgage rates are lower, building permits should rise, and vice versa. And so, if interest rates fall, you can see mortgage rates fall, and that would tell you that you should expect there to be a pickup in housing construction. Why wouldn't there be a pickup in housing construction? Well, if the economy is cooling more than expected. If the economy is cooling, so if the job market or if the labor market is softer than expected, if the job market is soft, let's put it this way. When the job market gets soft, consumer sentiment falls and consumer savings rises, okay? And this leads to a small reduction in consumer spending. small little variations in consumer spending can throw the economy into a little bit of a tailwind, right? Or a little bit of a tailspin. So that's the kind of backdrop that we want to understand. So if we're in an environment where consumers are saving more of their paycheck, even if mortgage rates fall, would that actually spur them to purchase a bunch of homes? Right now, I'm a little skeptical. I don't have a trade on, but I'm skeptical of that. I think that it's still going to take some time, and we'll see this in the data. You're going to have to see that mortgage rates stay low for some period of time, and then you're going to actually have to see a pickup in economic data points like PMIs, and that will then tell you that okay, maybe we've hit the bottom in employment data, and that consumers are going to feel more confident. And then, of course, why not? Why wouldn't they go and buy more homes? So I feel like there's still some headwind left. Now, why is this important? It's important because these jobs, right, plus the recent news about layoffs and production pauses in auto manufacturers and OEMs, those have big downstream effects. Okay. So for every car that's built, there are 4 doors, lots of windows, lots of panels. Okay. GM, Ford, they don't necessarily make all those parts. They're submitting orders from other companies to do so. If Ford is revising down their production number, then what does that tell you about their orders that they're sending out to their downstream, or upstream, supplier? They're cutting those orders, or they're just not reordering, with a higher frequency. So what does that tell you? That tells you that the current business that those upstream firms have is going to move down a little bit, right? So that subsequent orders are going to move lower. And what does that tell you about the employment dynamic? Well, it means that they're going to have slack. And if they're going to have slack, they're probably going to trim their workforce, or ask people to stay at home. So in that environment, you're going to see the unemployment rate rise. So we have two kind of headwinds that I think are enough to kind of shift the unemployment rate to the upside. If the unemployment rate hits 4.2, that gets us that 50 basis points for the Sam's rule, right? Does that mean that when on average when you see unemployment rate surge to and hit the Sam's rule, it tells you that the economy has been in recession for 5 months? Do I think that the economy has been in a recession for 5 months? No, I don't think that we're in a recession. I just think that we're actually running at a cooler pace than the market expects, and that interest rates are just too high for this. So my view is more about where I think monetary policy needs to be, and less about whether we're going to have a recession or not. I don't think that we're going to have a recession. I think even if the Fed makes a mistake and cuts way too late, I'm still not convinced that we're going to run into a recession. And it's not that it's because I think that the economy is so strong. It's just that I think that balance sheets aren't overextended in a way that would result in a recession. So you would have some labor rebalancing for sure, but it's not that there's been a massive surge in credit and that there's this massive overhang, right, in the economy that has to be digested first. That's what happened in the Great Financial Crisis. We went through small little technical recessions in 2018 and in 2014, I believe, or 15 previously, and no one even remembers them. So I think it's going to be more like that than a something that's really bad and serious. But again, I think that this view has more to do with where interest rates are going to settle and less about whether we're going to hit a recession or not. I really don't think that we're going to have a recession. So that's kind of like the dynamic there. So this is like the data point. When is this data going to show up? Well, it'll be showing up in August when the BLS, when they are surveying people in the household survey, and that will then be published in September. So that's why I'm saying in the September NFP, or like the August NFP that comes out in the first week of September, that's where we're going to get this update. So in that environment, if we see that the unemployment rate has moved higher, now keep in mind that the Fed has penciled in 4.1% unemployment at the end of the year. If you get the unemployment rate that moves up more than that, 4.2 by August. And if it looks like the trajectory is, it could get a little worse. So we're not seeing like a balancing act that's happening in other economic data. Then I would tell the Fed that the unemployment rate, like the beverage curve, is working and we're downshifting, and so therefore the unemployment rate is going to continue to rise. And in that environment, I would expect that the Fed would go from a two cut base case scenario for 2024 to a 3+ cut scenario in 2024, where you could get a 25 and 50, like a 25 in September and a 50 in December, or a 25, 25, 25, or depending on how bad the data point is, it could be a 50. We'll see how that data point comes out. But this is the regime that we're going to switch into. So previously we were kind of in this regime of there are some on the zero cut. Maybe we got a hike, right? Stephen Moran, Nouriel Roubini. There's a whole camp. There's a George Robertson, right? There's a camp of people out there that believe that the economy is running at 6%. And that is the zero cut camp, okay? Reacceleration in the economy. Then in the second camp, you then have the views that we're having a material slowdown. Others are saying we're just normalizing. So in a normalizing environment, you would expect that, long end, rates, they really shouldn't shift that far from what the SEP guidance has been, right? So, still 4.1 by the end of next year, for example, for the Fed funds rate. Now, the other camp, which is, well, maybe the economy is, cooling, more materially, that is obviously at a much lower level. That's going to say maybe 3.5%, right? So that's where we're going to look at this guy. So over here, for example, we're seeing that the market right now is pricing 3.5% by the end of 2025, the end of 2025. Okay, so this is that, okay, the economy is actually slowing materially camp. Okay, and that's what's being priced in right now. At this moment, that's what's being priced in. And they're pricing it pretty much, fully. Okay, this is where the Fed, they're saying that the Fed funds rate is going to drop 200 basis points, by the end of next year. Okay, that's 8 cuts altogether. And so going into this FOMC, my view is that the Fed would want to preserve optionality, and therefore Powell in his press conference would push back against a greater than 6 cut next year scenario. But in the conference, he actually is articulating what I'm saying, which is we've shifted into a different regime. Now it's no longer are we in a 0 cut environment or a 2 cut environment. It's now are we in a 2 cut environment or a 3+ cut environment range, And so now that will shift all the probabilities. And so in that scenario, I think that, okay, yeah, it makes sense. We would get SOFR to move out to that. Now, this is on the rate space. How does this translate cross asset? So the biggest thing that this does on a cross asset basis is because this is now pricing in that material slowdown, so a 3+ cut environment. In a 3+ cut environment, what does that tell you about the economy? That tells you that the economy is not just normalizing. That tells you that the economy is now materially slowing. Okay. So that tells you that the economy is going to be much weaker next year. Okay. So in this environment, what do you think is going to happen to economic estimates for the rest of this year and next year? Are those going to be flat? Are those going to move higher, or are those going to move lower?
Going to be lower.
Yeah, exactly, right? They're going to move lower. And therefore, monetary policy is going to have to kick up to the other gear. So what does this tell you immediately about what you should see happening with the dollar?
So weaken.
Right. Dollar weaker, dollar much weaker. Okay. What does this tell you about stocks? Should stocks, okay, what I want you to think about stocks, I want you to think about, break down the stock price into 2 parts, EPS and multiple. What do you think is going to happen to EPS estimates?
Revised lower?
Yeah, those would be revised lower. And what do you think is going to happen to the multiple?
Contraction?
Rates is down, right? So
so it's a balanced,
it's a balancing act, right?
Not moving too much.
With the rates coming in, the multiple actually expands a little, right? Well, it depends on how bad of a recession you think we're going to get into, right? If you think, if you think that we're going to enter into like a recession, then all bets are off and the stock market crashes. Everything goes down. But if you think that we're just going to have like a slowdown, economic growth is going to be at like 1% next year, for example, and so not a contraction, then you're just saying that R is going to be much lower. G is going to be lower too, but R is going to move much more than G is, and so the impact of the multiple is actually a higher multiple
increase. Yeah.
So if you have a higher multiple, which type of stocks do you think are going to outperform? Duration, right? And who do you think is going to underperform?
The financials.
Value and cyclicals.
Oh, not financial. I thought they'll have the interest rate differential.
Yeah. I mean, financials will be impacted too. Financials, I kind of classify as cyclical. It's a cyclical sector.
Yeah. So cyclical and value.
Right, cyclical and value. So those sectors would underperform. And what is the performance today? We saw that Qs are up right now. I'm looking at Qs right now. Qs are up almost 4%.
Q's crazy today, yeah.
Okay. S&P is up 2%.
Yep.
Where's the Russell?
Where's IWM?
It's 1%. Roughly. Give or take a few basis points.
Russell had like a big wild intraday move, I think.
Based upon his comments, yes.
Yeah. That really that scenario that we're talking about, I think just tying into the business cycle with currently, layoffs plus at least in my space, layoffs plus people taking off orders for the suppliers. And that will have at least semi-annual impact on the supply chain, because like you gotta do the tooling, and then you gotta like re-ramp up the production. It's like a very long process. And I guess like the argument makes sense on the auto side just as it makes sense on the housing side, because housing is on a much greater scale, but they are both products where you have tons of mini products built in, right? You got to build a fridge, you got to have a microwave, right? You got to have all the lumber and stuff. So it's like a big product that has tons of supply, and these supplier has their own suppliers. So, and yeah, I actually checked out Denso and Aisin, which are Japanese auto makers who reported today. It's like inline Q1, but they cited material weakness in Asia auto sales, especially also on the Toyota side. So yeah, they lower their full year guidance. So that tells you that the tier, we call it like tier 1 suppliers of big OEM automakers, their earnings are being hit and they are pulling back on their guidance for the fiscal year. So and that's just not going to impact one quarter. That's going to impact multiple quarters. If you think about idle capacity, and they're going to take those off, and they're going to lay off people. And when there's a recovery, you got to rehire, retool, re-ramp up. It's not going to recover like really quickly. Not like software company. I guess it's like you put a switch on and it's back online.
Right.
So like on the cyclical sectors, you definitely have this major headwind, which kind of makes a relative value trade more attractive in the space, because you can identify those players who are still growing faster than others and have more nimble supply chains. When I say more nimble, it's like they have more in-house rather than relying on tier 1 suppliers. So so that's what I'm thinking, hence why I'm keen to expand a little bit on my coverage, because it's hard to play on 3 stocks with a relative value, with 2 of them having like double-digit short interest ratio. So yeah, and so this is really, what's going to be honest on the cyclical side. In my view, that will get hurt in this cycle, and then probably reposition for another rally like much later when we have the second leg or like the next leg of ramp up.
Right. Yeah. And so with
Wait,
this,
does that impact your Apple thesis, by the way?
no. So
like
I mean,
the iPhone, what's it called? The replacement cycle is still intact.
yes, and I'll explain.
Okay.
I'll explain. Yeah, I'll explain how that works. So
Okay.
what we're talking about right now, this is like factor level. So how do we play this? How do you play this? You only play this at the macro level. Okay, so don't you really don't want to play this at the security level. So for example, if I had a view that value is going to outperform growth, it's not that I'm going to look to go and invest in value names versus growth. It's that I'm going to go make a trade on RTY versus NASDAQ.
Okay.
IWM versus QQQ. Like that's how you express that trade. And the reason why is because the view is on the factor, which is a systematic, it's a characteristic, it's a product characteristic. Okay. When we get to individual names, this is an expectations gap that we have on the ideo part of the return, not on the systematic part of the return, right? So that's where we always want to make sure that is always bottom up and always ideo. And the way and how do we manage this is when I look at my long short book, I want to look at my risk. I want to see what my risk exposure looks like. And I don't want my risk exposure to be very high. I want it to be as close to, say, zero or neutral as possible if I'm a factor neutral investor. If I'm a value investor, then you would expect that I would have a tilt, right, to value, a net exposure to the value factor. But otherwise, if you're just like, no, I'm not a factor investor, I'm a tech investor, I'm a this investor, then your net is to that thing that you're tilted to, and everything else you want it to be pretty neutral. So when I run my book, I'm going to try to neutral my long and short positions. And then in a macro sleeve or book, I can maybe express a trade here. But you're always going to do it separately. You don't want to mingle a factor-based idea with the stock trade with individual stocks. You could do a basket, you could do an ETF, but you don't want to go down to the individual level.
Okay. Yeah.
Cool. So, and if you look at this, with this chart, this is, by the way, this is the chart that I was referencing, Andy. So,
did I give you the right one?
No, but that's okay. Oh, actually, I think you ended up finding this, so that's fine. So this is 3 months SOFR, and this is what the curve looks like, and this is like this. The white line is today, the orange line was last week, and the blue line was a month ago. Okay, so you can see how the view has moved substantially, right? Like look at how a month ago, the 2025 view was that rates were going to be in line with SEP. Okay. Today, the markets are pricing in like 65, 70 basis points of cuts. So like 3 cuts more than we were pricing in at the end of last month. At the beginning of July. Okay. And then since last week, it's almost a cut. Like the market is pricing in almost one more cut than it was last week. So this tells you a lot about where the market thinks the trajectory of data is going to go. Okay. Now, where would we expect 3.5%? If say we think that like long-term GDP growth is going to be, on average, say 2% that's your real, that's your R star. Then you're going to have your nominal yield will be equal to your real rate plus expected inflation, right? So at say a 2% GDP growth rate, you would expect that the Fed funds rate would be at say 4%. Okay, that's where your nominal yield would be. So you can see that like that's where the market goes in the long run, closer to like that 4% mark. Okay, and that's because the Fed has this goal of trying to get 2% inflation and roughly 2% growth. Okay, so rather that the 2% inflation is the growth that the Fed is trying to guide to. Okay, so that's why you see that in the long term you get to this like 4% range. And in the short term, you get below that. So now you can see and this is like a rough estimate. This is how you can try to figure out what the market is pricing in. So I could add, and this is not going to work here, but I could add like an inflation swap. Not sure if I can do that here, but I could look at like what an inflation swap is looking at. And I could say that, okay, well, that's at 2% by the end of 2025. So if an inflation swap is at 2% at the end of 2025, and the market, like SOFR futures, are pointing to 3.5% at the Fed funds rate, what is that telling you about the real rate? 1.5%, right? It's just going to be a lower growth rate.
Right. Yeah.
And then by 2026, you see that it troughs at 3.3%, right? Which is getting pretty close now to a 1% GDP growth rate. Okay, so then you can compare this to what is our US economic forecasts. It's this guy, but I'm gonna change the for 2026, that's at 2%. Okay, at 2027, it's nothing yet. So at 26, we have 2%. Okay, and so if we know where inflation swaps are, I'll just look at the 2-year. That's at 2.2. Okay, so 221. Now I take a look at where this is trading. So 2026. Okay. This would be 2 years out. So 626A. That's 3.35. So if I do 2.21, or if I do 3.35 minus 2.21, what's now the market implied GDP growth rate by in 2026?
1.1.
Yeah, exactly. Okay. And that is below the 2% that is currently being forecasted.
So are they saying the Fed will cut too late and too little that we won't even achieve a recovery by 2026, or like be higher than 2% by 2026?
I think, I mean, yeah, it's possible. I mean, they don't expect that the market right now is not pricing in a trough until 2027. It seems late 2027 or early 2027. Okay, so that seems like where the market pricing is. But I would not I would instead think about, well, where do you think GDP is going to be in that time period? Is 1.1% really where you think GDP is going to land?
I think it should be higher than that.
Okay.
I think it will be closer to the historical, like where the Fed is targeting. Because by the time in 2026, I think we're approaching the end of the cutting cycle. So it's either we
How
achieve
do
the
you
goal
know
or
that?
yeah, that's why I'm just just from my in my view, um, but like
So
if they don't achieve this goal, they need to cut further. Like we have much bigger problems. If
okay,
you
so
let's yeah.
so think about it in this case, okay? If you don't expect if you expect a recession, then you expect growth to be at 0 or below 0, right?
Mm-hmm.
So, but then it's like, how long will a recession land? So clearly, this pricing is not pricing in a recession. Okay, like I want to make that clear. Like this is not pricing in a recession.
Mm-hmm.
This is pricing in a environment where GDP growth is anemic at like say 1%. Okay, and you should think about what do you think the odds of the market going to a 1% growth rate is? Is that your like base case scenario? Like if you think about it, like you have 2+% growth, 1 to 2% growth, 2 or 1% and lower growth. Where do you think the distribution lands
What year?
by
2026.
2026?
I'm going sub 1, so but you.
You're saying sub 1?
Yeah.
I
Okay.
I think it'll be around 2 to 2.5.
Okay. So let's
I'm
this is
I'm
again,
looking
this is
at
what makes a
historical
market.
chart. I'm looking at historical charts here.
Yeah, no, this is what makes a market. Okay. So we have we're gonna
Make me a
have
spread.
yeah, right. So this is like the range. We're gonna say this is, if you guys can see this, 2% plus. Oh, I'm gonna have to make this bigger and brighter. Okay. This is gonna be 1 to 2%. This is gonna be, under 1%. Okay. So let's talk about where this goes. I want to say, okay, so for Yefeng, you are saying that, okay, what do you let's do this. Okay. Yefeng, for you, what do you think the odds are on a just think about like, okay, on a scale of like, 0 to 100, right?
Mhm.
What do you think the odds are of GDP growth by, this is going to be GDP, okay, by 2026? Where do you think US GDP is going to be? What do you think the odds are of US GDP being below 1% are by 2026?
Mm, just give it like a 30 to 35, I would say.
Okay, so I'm going to say 35%. You're saying that okay. Okay, what are the odds that we're going to get between 1 and 2%?
I'll probably just let me see. Give it like a like 45.
Okay. And then what are the odds that we get to 2% plus? I mean, this
Just
this
1
this is going
minus.
to equal the remaining. So this is a
Yeah, 1
20%.
minus 20%. Yeah.
Do you agree with that distribution?
Me?
Yeah, do you?
uh,
How would you shift this? How would you calibrate this?
okay, so 20% is from like a little bit higher.
Okay, so what would you make this?
Um, I'll make it lower to be honest.
Okay, like 19%, 15%,
Probably just like
10%,
10,
5%,
probably just 10, just 10,
10?
10%,
Okay.
yeah.
So we're going to say 10%.
This is fun.
What about what about between 1 and 2%?
Okay, so I'll probably just like add like 5 each to like both scenarios. It's like 40.
Okay.
40, 50, 10.
Okay. Okay, that's fair. Andy,
Yes.
you're up.
Okay.
Where would you set the range?
20, 30, 50.
Okay. Right now, I don't care about the quality of your reasons why you have a view. Right now, what matters is you have a view, right? And then you want to optimize, right? Like you should be incentivized to like calibrate your view and your weightings based upon the information that you have, or you run the risk of being wrong a lot, right? So this is not a discussion about like how right do I think either of you are. It's just a question of like where are things, right? If you look at where the SOFR curve is, it's pretty much pricing. I'm gonna put SOFR. Okay, it's pretty much pricing this. Okay, at a very high level, and this at a lower level. And I would say there's a smallish chance of a recession that's being priced in. Where would I get like more precise information? I would extrapolate it from the deltas on the call options or of the options on SOFR. Like that's how I would extrapolate that information. And I would look to see what the distributions actually look like, how people are actually positioned. But for right now, like the shift over here is that the central tendency is about 1%. So that means that the central tendency is somewhere over here, right? It's between these two. So because the central tendency is there, I would say that this means that the 1.1, that's like your 50% mark, right? So that tells you how your distribution is going to look like, and I don't want to try to extrapolate further, but you can see that the market is actually pricing in this range greater than both of you are. Okay. So if you're a trader, okay, how would you describe this position that the market's in?
Trader, it's like not pricing my scenario, which means if the market's wrong, then there's like a gap where I
Right,
will
there's an
fade,
expectations gap.
where I will fade the move.
Okay, right. You're gonna feel a bias towards fading it because the market is pricing in a scenario at too rich of a level.
Yeah.
Okay, the midpoint between your and Yefeng's view is a 30%, and the market is pricing it. The market is pricing that at a much higher level, right?
Yeah.
So, you would say that okay, the market should be at 40%, but it's at 50%. So that makes you more skeptical of the market's positioning. Okay, that's the first pass. It's like the first wave. Okay, that's kind of the view. What's the second step that you want to do? Now that you kind of have a view, okay, I'm skeptical of the market pricing. Okay, I want to fade this. What's the next thing you need? Oh, you kind of have a view now that okay, the market is overextended. What's the next step?
Price the scenario to see what the odds is.
Well, I assume that you know that the your initial like response about fading it is because you've already priced in the scenarios, right? Like that's pretty much what we did here, right? We priced the scenarios.
It's like understands what your opponent is doing, so just like
Yeah,
sell side
right.
scrub.
What was that?
Like understanding
like
what
the
that camp of
sell
people are
side
talking about.
scrubbing, right? You want
Okay,
to know
but
like what you're like.
assume that you're already an informed investor, right? So you're already on top of you're reading sell side every day, so you already are aware of the narrative.
Okay.
So what's next? What's the next step?
I want to say put the trade on because like first off,
You
wrong.
you need a couple things first.
What is the
What do you guys need next? What do we need next?
um?
I think.
I, 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 So we need to yeah, go ahead.
We need to find like the how can we kind of like generate like maximum P&L with this like expectation gap, because you have like various ways to express your idea.
Okay, you're on the right track, but we need to do something before we do that.
Find out what asset class you want to play in.
No, that comes later.
Okay.
Okay, I'll just spill the beans. What you
Okay.
need is you need the catalyst. What's going to make the market move in your direction? Okay.
Right.
Yeah. You're right.
Because then you're going to know the dates. And if you know the dates, then you can price in the options.
Yes.
Right?
Yes.
Okay.
Yes.
So what would be, off the top of your head, what do you think would be a catalyst for this trade?
First of all, FOMC meetings, because that's the where the rate decision will go.
Okay.
Secondly, all of the ISM prints. Yeah, I like ISM prints, the labor market prints. Those will tell me where the economy are at, and whether how big of a recession are we talking about, for example, right? And that will validate my point or not.
Okay.
Like
So,
in general, it's just leading indicators, economic indicators tell me, what the economy is doing so far.
okay. So let's like, we're gonna start from the beginning and then so we can kind of work through this. Okay. So the initial thing is we're informed investors. We know what's happening in the markets. We have somewhat of a view before the market or before the FOMC meeting. Now the FOMC meeting happens, we see the market reaction, and we have our scenarios priced in. And our scenarios incorporate all the these are our prior views, right? So these incorporates all of our information. What is the next incremental data point that could potentially shift our prior views?
Right now it's like labor, right?
Okay, so when is that?
So an NFP is like Friday, right?
Right, it's Friday, right? That's your first catalyst. Okay.
Okay.
That's your first opportunity to make money. What would you need to make money here? Like you think that the SOFR curve is too rich, so you'd want to sell the SOFR curve, okay? So that means that you think that this is going to be priced, we're going to move up, right? Not that you think that it's underpricing a recession scenario, so you think it's underpricing a better economic scenario. So what then does that imply about your view of what's going to happen in August or for the NFP print on Friday? Do you think that would be like, I mean, you may not know this yet, and this is why you go through this process. This is like your due diligence on your trade idea. So now you have to think about, well, what do I think is going to happen on Friday? Do you think that we're going to get a hot print or a soft print or an inline print?
We'll get like an inline one.
Okay, you're thinking about an inline one. Andy, what about you?
Same, inline.
Okay, so an inline print. Would an inline print shift the SOFR curve?
No.
No.
Yeah, probably not that much. This is where the sell side scrub comes in, because if you're seeing in sell side that they're saying, oh guys, the July data has been really weak, August NFP is going to come in and blow out to the downside, then you have an awareness that this is a catalyst that the SOFR curve is pricing. But if everyone is saying, oh yeah, expect in line, then this is how you know what to scrub for. Then you know that, okay, that is not going to be that big of an issue. So you're probably not expecting a big change in the SOFR curve on Friday. In that case, sorry, go ahead, Andy.
Oh yeah, what I'm trying to say is, I feel like in this specific example for NFP, I think for it to shift materially, I need either a super hot print or a super weak print. Something in the middle is not going to move things.
You're going to need a surprise, exactly.
I think I need a surprise. Like either way works for the trade.
Well, no. Depends on the direction. So if you think that the SOFR curve is rich, which is what you think, like this is, you have to align your trades with your views, right? This is your view here, okay? So your view is that the economy is not gonna enter into, like, the likelihood of a recession is very low. Okay, you're actually viewing that we're probably going to see some reacceleration. Now you then have to think about, well, what is the path of the data going to look like? When will you know that we're going to be in a reacceleration? And you may be thinking, oh yeah, by like early next year we'll start to see an improvement in economic data. Okay, so then you have to ask yourself, well, what is the path of economic data between now and then? Is it like balanced? Is it to the downside? Is it going to go down first, or is it going to actually bounce up a little and be jumping the other way? Okay, so that's how you want to be thinking about this, right? So you say, okay, non-farm payrolls for NFP, you're like, I don't really have a strong view. I think in line. You do your sell side scrub. Everyone is kind of saying in line too. So then you think, okay, well, what's expressed in SOFR is probably this inline thinking. So in that case, if you think it's going to be an inline and the market thinks that it's going to be in line, do you put on a trade at that point?
No.
Exactly. Because the risk of you being surprised is pretty high. So you just, or you just don't know. And so there's no, and you don't think that there's going to be like that it's not that you have a view that you're going to get the data point that's going to track to your thesis. So because of that, because you're like, the impact is going to be neutral and the market is neutral to this event, it's too much risk for me to put on a trade right now. I need to wait till after this event. Okay. So then you get to isms, right? And then you get to CPI. So you're going to go through all of the catalysts that are going to go between now and the FOMC meeting, or multiple FOMC meetings, because then you have to ask yourself, when do you think this repricing is going to take place? And if you think that it's going to take place, because you're like, well, right now the market is expecting extra cuts because the market has like a view on this like really bad, the trajectory in the economy. Well, when is the market going to know that things are going to be really bad? And then you go through sell side and you see that, okay, people are pointing to maybe a weak August, like everyone sees it. So, okay, so that means that everyone is going to pay attention to the September non-farm payrolls, and that is going to go into the September FOMC. And so that is where you're really going to learn about if the Fed is going to really shift us to that 3+ cut regime, or around a 2 and then a 4, regime, right? So any more in line with your thesis, or still more balanced, than a very high, a very, like a 8, cut, regime. So now you kind of know what the path is going to look like, and then you're then going to have to figure out which event or which sequence of events, what are the sequences of events, and how are those going to ultimately lead to the market repricing your view. So that's the catalyst calendar. And when you lay that out, that's your path of monetization. That's how you figure out when you need to put on a trade. Once you know, okay, next week is going to be, or this week is going to be a dud, isms are probably going to, I was looking at weekly economic index data. Looks like transportation stuff looks like it's doing okay. So I have no reason to believe that there was going to be a material downside in isms. It's just going to be a little, chunky is going to stay where it is. So it's not going to cause a massive, repricing, but it also is going to like detract from the current narrative, which is we're in a 3+ regime. So it's not going to be isms. It's not going to be this month's, PMIs. But maybe August CPI is going to come in a little, hotter than expected. It's still going to show that we're on track for, 2% in the near term, but it's not going to show the recent, deceleration in inflation that we've been seeing. It's going to show like a little bit of a bounce back off of that. And so in that data point might be the one that triggers the market to reprice a little. So if that's the case, now I know, okay, well, I have two events. I got the isms, I got the, NFP. These data points, vol is going to be like, people are trading off of those. So vol is going to be a little higher around those events. So I don't want to, if I don't have a view on those events, I don't want to make a trade on those days. I'm overpaying. you know?
Right.
So I'm gonna wait until after those days, and then I'm gonna structure my trade around, okay, then the CPI event. So now I know the time period. I know when I'm gonna buy the trade. I know when I'm gonna get paid potentially. I know what I need to pay attention to, and I know what I need to get hyper focused on, which is the CPI. Now forget about non-farm, forget about NFP or ISMs or whatever. Like I need to be laser focused on, is there going to be a surprise in CPI? And I need to track how consensus estimates are shifting towards that, because if say right now consensus for in CPI is 20 basis points month over month, okay? And right now, my view is, it's going to be like 30 or like say 25 basis points month over month. And if between now and end of next week, consensus moves in my direction, do I still have the expectations gap?
No.
Probably not, right? So I would expect that SOFR would move in my direction, right? So if I didn't have the trade on at the time, I probably would be like, I would analyze to see has SOFR shifted over time or has it stayed the same. If it hasn't shifted, then I'm like, okay, good. There's still a surprise element baked in. But if it has shifted, then okay, SOFR has already moved in. Okay.
Yeah.
So this is how we go through the sequence of all of these things. But it sounds like there's a lot of steps. It's not really a lot of steps. It's just that we always pay attention to like the top of the funnel, which is like the hunch. Oh, this looks interesting, or I want to fade it. That's actually the very easy. That's like for us, that should be very easy because we're relatively informed, right? Like we're kind of on top of what's happening. But then the workflow that we go through, it's not really about going and generating ideas. It's just a matter of doing the due diligence on the ideas that we have. And we want to do it where it's like, I have a hunch. Let me price my hunch versus where the market is. Okay. So I got to find a benchmark of what the market is. And then I have to compare it to my pricing. And that's what we have on the screen. And then once I have that set, now I have to figure out what my catalyst calendar looks like and then what the path to monetization will be. And that's going to be like, I just lay out the catalysts, okay, the events that are going to come up, and then what I think about those events. So I'll spend 5 or 10 minutes, look through consensus estimates for these events, and then try to understand a little bit about like a narrative around what's happening. You're not going to find a ton of data, and that's fine. You don't have to, this doesn't have to be like, you're not going to write pages on the path of monetization. This is going to be simple, bullet points, but you're going to lay it out so that way and then you're going to try to find or isolate the key events that are the critical factors, and those are what you have to get hyper focused on. You almost have to ignore to some degree everything else and just focus on those things, and then look to see how the market is incorporating information, and then pay attention to sell side. Hey, is sell side agreeing with me, or are they disagreeing with me? And then are the markets moving with sell side, or are they moving against sell side? So those are the things that we do. Once we have that set up, now we can price the trade. We can go and say, okay, how do I want to structure it? We can try to maximize the payout because now we have the dates. We know when we're going to put on the trade. We know what the structures that are going to look like. They're going to pay out the most potentially, and we're ready. We're good to go. So that's how we want to structure. I mean, that's like the idea generation process, or like the idea due diligence process on the macro side. So our view of looking at SOFR curves and translating it into a trade would be, okay, well, we have this view now. SOFR is pricing in much greater. SOFR is a little rich to our view of where we think GDP is going to land next year. So, SOFR is overextended. That makes it sensitive to, news, on the other side. So if we get a data point that comes in that throws a wrench in that, boom, SOFR is going to move back really quickly. So this is juicy. I like this. This is a good setup. This is great. Now it's like, okay, so when am I going to get paid? Well, we got NFP, we got ISMs, we got, we're going to get services PMI next week. a bunch of data points. Then we're going to get inflation. Then we're going to get, or we're going to flash, PMIs. We're going to get a bunch of data points, right? So then we got to figure out like which of the data points really matters. Where's there going to be the most volatility around the KPI? Once we find out what that is, we can then express our view, and then we have to monitor it because we get new incremental information that might change our prior, and that's okay. It's totally fine. That happens a lot, actually. Many times I'll see a trade and I'll kind of bake it out, and then in the run up to the trade, information comes out. It's different. It changes my view, and so you either take the trade off if you haven't put it on, or you just don't make you just cross off the trade, and that's totally fine. The idea here is just to get better at running through that process. So then it'll feel natural to you. You'll just be like, you'll immediately be able to say like, oh, like okay, like the yen, for example. Oh, the Fed made this action, so SOFR is rich, which means which means dollar is weak, which means yen is strong. The next data point is, say, CPI, that I think is going to be the catalyst. Maybe the trade to make is a short yen position because the dollar's going to rip in the other direction, when this happens. Market is overpricing a 2+ cut, regime, when I think that we're still firmly in the 2-cut regime, environment. Like that's then you can kind of quickly, figure that out and lay it up.
Yeah, I think that's a really good practice to go through.
Cool. The way that I'm probably gonna express this right now, what I'm thinking is, so first of all, I'm gonna acknowledge that I got this wrong. I did think that the Fed was going to push back against a 2+ cut regime. The Fed didn't. The Fed is explicit, or Powell, let's put it this way. Jay Powell is explicitly saying that we now have 2 potential regimes that could flip into. We're shifting the paradigm. Before it was a no cut or a 2-cut, and now it's a 2-cut or 3+ cut. Okay. So this shifts the regime. Okay. And what does this mean for the market and for the economy? Well, what this means is, in a 2-cut regime, the trade is between reacceleration and soft landing. In a 2-cut regime, a 2-cut versus a 2+ cut regime, now we're debating whether we're going to have, a really material slowdown or a soft landing, right? And so the market now is pricing in that really material slowdown. So what does that tell me about, where then estimates would go? Like if that is true, that we do have a material slowdown, if I believe that the markets are accurate, then I would expect that estimate revisions were lower. Now, that was already my view, that the economy was slowing and that we were going to get lower, estimate data. So that view is not changed, but what is changing is the monetary response to it. So previously, my view was very neutral on equities, because I felt like what was going to happen was a 50 basis point, right, or like a marginal kind of a change, like pretty neutral on equities, but a factor rotation that takes place. And I think that actually over a 1-week period, I mean, like today the market is up, but like look at the past couple of days, right? So roughly over the past week, we're probably going to end up being close to flat. But I think that we're going to see this factor rotation take place, where you're going to see that the IWM will have underperformed versus triple Qs, and that will be an extension of this kind of long duration trade. To some degree, that's also the signal to go long duration itself, right? So there's that aspect as well. So that was already kind of my view, kind of going in. But still, for next year, I wasn't really pricing in a really material decline in the economy, and now I think that SOFR is probably, I'm like in your guys' camp, where I think that SOFR is probably it's pricing in a 3+ regime kind of too early. I still think that we're like, it should be closer to say 50-50. So I would say that interest rate probabilities for December should be at 2.5. And today, interest rate probabilities for 2025 should be closer to say like 3.8. Like 3.875 is probably I think the right point. So I would then expect that to some degree markets would give back some of this. When would that take place? That would have to happen. The data this month would have to kind of point to that direction. The market is already pricing in what I thought it would price in September. Let's put it that way. So the market has moved, well ahead. And so I do think that we have to have some get back to that. But the question is, do we just stay at these levels and fluctuate, or do we actually move? Is there going to be some movement? And that depends on the data, if I'm going to be surprised or not. Right now, I don't know if I'm going to be surprised or not, although my thinking is that non-farm payrolls for July, like that's really what I'm going to look into. Like, could there be upside to non-farm payrolls in July? Could there be upside to PMIs, in July, from July? Could there be, I'm going to look at all the data points, that come out that are meaningful, and I'm going to try to see, is there any upside risk to any of them? And then if I can find any where there's some potential upside risk, I'll then have to think about how I think this will impact the pricing. Now, like just in simple terms though, if I have soft non-farm payrolls, so soft NFP, soft ISMs, and a inline CPI, is that really going to move the curve much? No, right? So I would need to see chunky volatility, so like big macro surprises in either direction, or sequential, heat, I think, to really kind of shift the narrative. Still, though, I would expect a little bit of a give back here in SOFR curves and where, maybe where rates are. But probably not that much until we get a data point that actually confirms that we're overextended. So I would say that we're going to trade kind of within standard deviation, of where the rates are.
So here's like my question. I know ISM is super, it's weak for a couple of months. And we are seeing these layoffs and some weakness in the sectors. But what will cause like a serious recession? I know we talk about the commercial real estate with the rate coming down. I think we kind of like diffuse that bomb. What else that will have an impact on the entire economy that will cause people to lose jobs? And like when I say lose job, I mean like on a big magnitude, and then really like a shock to the economy, and then after that, wealth effect and the channel of money going through the system doesn't work anymore, so you get less corporate sales. Like what are the situation that like what are the cases that will happen? I'm not seeing any signs.
Yeah, I agree with you, but I think that it's good to distinguish between a recession and a crisis. So I think that you can have natural contractions. I don't like to use the R word. I think contraction is the right word, which is a small contraction in growth that can happen as just part of a normal a normal cycle of growth. So it can be healthy. It's part of like a healthy kind of growth cycle. Now, what exactly is the mechanism for this? Okay. When you look at real business cycles, you're looking at unit changes. What drives unit changes in the economy? And there are really kind of two primary factors, and the third being monetary policy shocks. So the first factor is technology. When technology improves, it can lower the cost of unit production, which can increase supply. Okay. The other thing that can happen is if there is a bottleneck on supply, you can get a decrease in the output. Okay.
Mhm.
So those are the two things. They're primarily supply related issues. One is the cost of production goes down, so supply can increase. And if
Yeah.
supply increases, what happens to real output? Does that increase or decrease?
The increase.
Right. If a factory gets blown up or you have a major
Then
bottleneck,
yeah.
output decreases, right? So ultimately, this revolves around either there being a supply bottleneck that'll cause a recession. Another thing that will cause a recession is potentially government spending. If the government sweeps screens, then what does that tell you about a pub or private consumption or private output?
Like the crowding out effect, right?
That is the crowding out effect. Okay. Now,
Okay.
is that something that like actually happens? Yeah, it actually can happen in weird ways where you can get the, say, I'll give you a good example. So sometimes, like for example, a limiting factor sometimes on oil production is the availability of certain types of pipes, certain types of piping. If the U.S. government, the federal government decided to make a massive investment in like a new infrastructure deal and they swept screens on all the pipes, there may not be enough piping for like the oil wells might be capacity constrained on production.
Yeah.
Okay. So subsequent production doesn't grow that much or it could grow less than expected. Okay. So that's how the crowding out effect works. And it typically is a very like a little bit of a short-term, impact. You can actually see this in ISM PMIs because they will list the items that are in short supply. So
Yeah.
that's
I remember
that's a
that.
good
Yeah.
signal for that, right? So you have the crowding out effect. That is the primary thing. The other thing that drives recessions is monetary policy or the monetary policy.
Yeah.
And the way that it does it is in two ways. If it creates a shock, then what it does is it'll dramatically move interest rates, which requires 1 to 2 years for contracts to reset. And in the interim, in that 1 to 2 year period, it makes the cost of those arrangements too expensive at the existing price. Okay. So for example, you were going to buy a car, but to buy a $20,000 car and now is going to cost you the equivalent of buying a $30,000 car. That might move it out of your budget, right? So in that case, you're just going to hold back on purchases. But that's purely because the Fed raised interest rates. So that creates that pricing dynamic, okay? It'll eventually fade, but that's what creates that initial kind of shock. The other thing is that when the Federal Reserve has an interest rate when R is above R star, okay, when the actual nominal yield is above the real or above R star, what happens is it slowly siphons capital out of the economy. It increases the demand for savings, okay, and reduces on the margin reduces consumption. So in that environment, it also depends on the mix of assets. So like this goes back to TBAC and TGA and how what's going on there and bond issuance, blah blah blah. But the federal government can soak up liquidity in an environment where the savings rate or where interest rates are higher than the growth rate in the economy. Because what that tells you is that the future value of of assets are actually worth lower in that environment. You typically higher interest rates should correspond with higher GDP or higher growth rates. But when higher interest rates are above growth rates and they're moving in the opposite direction, that's a negative signal, right? So in that environment, you can get capital that gets marginally allocated into fixed income, into like government bonds versus actual productive activities. So that's like another policy thing. So those are like so the technology and government can impact real output in the economy, and then monetary policy can create like an impediment which can delay right activity. So if it delays
Mhm. 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 Mhm.
activity in that subsequent period, activity is lower. Okay. these are normal recessions, right? That are gonna drop the economy by like say 1% or like 0.5% or 25 basis points or whatever. That's like 2018. It's like 2015, the manufacturing recession, right? That's what that dynamic looks like. So that's recession, or I would say contraction. And then you have shocks or crises. Okay, a crisis is completely different. You had the currency crisis that happened, right? You had that currency crisis that happened in Asia in the late 90s.
97, yeah.
Right. You had before that. You had the ERM and UK. The Bank of England got destroyed. Right.
Yeah.
You then had the .com crash, which was a little different because it didn't really. There was a recession in the U.S. economy, but not really that much. Right. And then you had 9/11, a couple of things that drove that, and then you had 2009. Right. That was a legit crisis, and that was a crisis in multiple ways. So for a crisis, you have to have a major market failure where the bag holders are widely spread.
Yeah.
Okay. Because then you get a hit across the entire economy.
Yeah.
In an environment where the risks are narrow, for example, there was a European crisis that happened with the pigs, right? I hate to say that, but Portugal, Ireland, Greece, and Spain, right?
Is it 14 or 13?
What do you mean? Oh, I thought it was actually between like 11 and 14. Like it was a couple of years,
when I
right?
was in when I was in like primary school, like middle school, I remember that. Yeah, like
right?
the testing temperature for me every day. Yeah, I remember that. Yeah. Okay.
Yeah.
So yeah, going back to like today, right?
Right.
I don't see a crisis situation. I see a contraction issue. And the contraction issue to me is the oversupply after the supply restraint. Like people ordered too much at too expensive of a contract price. And right now when we realize we don't really have that much demand and people stopped panic buying, you have this extra backlog and inventory. I think inventory that people need to clear out.
Right.
And I'm seeing this in the consumer sector. I know less about the corporate sector. For the consumer sector is exactly what's going on right now in the watch space, in the clothing space, and like you see discount everywhere. And what that tells me is right now we are in a period that not all people is ordering in bulk in the consumer space, especially those big corporations. When they actually start pick up and rebuying, is the moment they feel, oh, actually, we reach another kind of like, I don't want to call it like supply constraint stuff, but like the inventory is too low. Is the moment they'll restart buying. So that's kind of like my view on the reason why we'll have like a correction. Oh, nice inventory graph. Yes. So I think once that's ironed out, then the technology advancement is gonna overpower the recession aspect, because we do see the technology developing, and I think this time, and then plus like robotics, I think it's gonna kick it up another leg on the economy.
So you're saying 40% GDP growth?
Not 40% GDP growth. more than 2% is what I'm trying to say. Okay, so is inventory?
Yeah. So there are two things that we're looking at. The blue line is the change in inventories, and the green line is the level of inventories. So you can see how even though the change in inventories has dropped, the level is still
elevated,
quite high.
Yeah. And I mean with layoffs, with all of these headwinds in the near term, I don't see that coming down anytime soon.
Right. And so little contractions in the economy, right? An inventory overhang is a great illustration of like how you can get disinflation and a contraction in output, because in the subsequent period, like, so the inventory is just too high, right? There's got to be a digestion period. And so
right.
in a digestion period, your output growth is just lower than it was in the prior period. So
Yeah.
if you have smaller output growth, right, now you're going to get, now you run the risk of a technical recession.
Mm-hmm.
So yeah, I totally agree, in that lens.
So, here's why I think why the rate cut is going to help with the situation, because like you said, like it's going to bring these items into the purchasing budget, or like if it's on the higher end, you actually save a little bit of money, like buying them. Then it's going to help with the inventory digestions, meaning we'll be recovering from this quicker than if we have a high interest rate.
Right. Exactly. Yeah. When the interest rates fall, you can see that that's like how can you clear goods? You have to lower price.
You have to
You could
lower, yeah.
either nominally lower the price, or you can lower the interest rate. Right.
Yep. Mm-hmm.
So if you lower the interest rate, then your nominal price doesn't have to move that low, and you can clear. So
You
that's
can
going to be
clear
good
this
for
inventory.
margins.
Right.
But if interest rates are high and you have to then lower the nominal price, that's going to be bad for margins.
Exactly. So hence I'm on this, or I don't want to call it recession, but like contraction / slower economy bandwagon for the remaining of the year, and it will spill over into the beginning of 2025. But the recovery after that is why I think the SOFR might be wrong. Pricing only 1.3?
Yeah. Well, 1.1,
Was
I
it?
think.
1.1, yeah, 1.1 for the GDP growth in 2026. I think hence that's why I think it's the price too rich.
Yeah, Fang, what do you think?
Yeah, I think you're muted. Is he still here?
Maybe he had to go pick up his kid.
Maybe, yeah. He probably gotta go pick up his kid.
He normally
So,
has
like,
to go around 5:30 anyway. So.
yeah, right. So this is kind of like where I stand. So I mean, it's like an overlapping of multiple factors. That's like what happened over the last 2 years that led us to where we are right now, and then how it's gonna move forward. So yeah, so in that sense, where I'm looking at my okay, so I'm gonna track inventory like a hawk if that's my thesis. Right?
One of the things. Okay, so one of the things that I think that we could see is if you look at the S&P, and you look at if you look at the S&P from a multiple standpoint. Okay. You have equities trading at a very high level. Okay. And you have to ask yourself, like, why should equities trade above where they were trading in, say, 2017?
Is it above like 18? Yeah.
Yeah, 2017, we saw synchronized global growth. It was like the Goldilocks era, like, it was like, full times pretty much. So why why should the S&P, trade for this? And what people point to is, oh, well, this is why. The number, money supply is just so massive. So you would need to see supply of money moving, and I need to pull up the right estimate. Let's go.
And non-seasonally, yeah.
There we go.
Yeah.
Okay. So you would need to see money supply come down. The blue line would come down
Right.
to whatever like the normal, nominal range is, which is not that far.
Not that,
Okay. And then that would bring the multiple in line with, that would calibrate the multiple. That would remove that excess from, that would remove the excess multiple. That there's an excess multiple that we have right now, and that's driven by the higher money supply that there is in the economy. So as that money supply gets drained, you would see that the multiple should begin to contract.
Okay. Question: can we do this on the equal weight and see what the difference is?
What do you mean equal weight?
The S&P
equal weighted S&P?
Yes.
Is there does it have
I think there is. What's it called?
There we go. Oh, yeah. Okay. So this is the S&P equal weighted.
Right. So this is kind of like my argument.
Okay.
Because if you look at the equal weighted, it has already come down.
Right.
But the Magnificent Seven has been taking the index way too high. But rightly so. I mean, that's where the technology expansion is for the next leg of growth. I mean, I think it's, it should be done, but the equal weight has already come back.
Okay, but if we even look at, say, the NASDAQ, it's trading at a much higher multiple than it was historically.
Right.
So like that's my point. Is that like you're right, that like obviously the Max 7 is driving it, and my point that I'm getting at is the Max 7 is trading at a much higher multiple, and what's supporting that much higher multiple, I mean, part of it is you do have massive growth, right? So like, yeah, of course, Nvidia is going from a $20 billion company to like a $200 billion company, right?
Yeah.
So it should trade at a massive, multiple, or it should see a massive expansion there, and it has. But is Apple seeing that level of sales growth?
No.
Okay, exactly. And most of the companies aren't seeing, Meta is not seeing that level of sales growth. So most companies, even in the Max 7, are not seeing that level of growth. There's like one company that's seeing a crazy, ridiculous amount of growth, and some tangential companies that are benefiting from that. But everyone else is still growing at a more, relative base. And this is, you can look at, for example, let's look at software index. I do S5. Yeah, so this is like another kind of good illustration. So this is like the software index, and software is not growing that rapidly right now. And so this was the high growth era. Okay, and the multiple is well above, that range. And so the question is like, why is the multiple in that range? It's because say the liquidity in the system is much higher than it was in the past. So because you have this big increase in liquidity, therefore you're going to have this impact. In fact, I've got my own. I think that's what it is.
Glow leak.
Glow leak.
Oh, liquidity.
Yeah. Glow like you. Oh, there we go. We got it.
Oh. Okay.
Or not. Let's see. Sometimes this can take some time to load. Anyway, so liquidity is higher, and so in a higher liquidity environment, you get a higher multiple, and that makes sense. So
Right.
I'm not arguing that these stocks are in a bubble. What I'm saying is that we have this liquidity that has driven up the value of financial assets, because what happens is, and this is actually George Stevenson, I think is his name. He's a economist. He used to be the Citi's rate trader, and now he does some YouTube videos. Had a really good point where he said that when you had the COVID stimulus, that was really a transfer of money from the public sector to the richest. That in between went into the bank accounts of, I don't want to say poor people, but into, the average person.
Yeah.
So eventually this money will sit on the balance sheet of the very rich. What are they, what are investors going to buy?
They're
going to buy
capital
financial
owners.
assets, right? They're
Yeah.
going to bid up the price of financial assets. So that tells us where the risk is. Okay. So the risk is right now everywhere is that financial assets are all bid up too much because of this money supply issue. So where there could be a black swan event is something that challenges that regime. If the Fed were to say, hey, right now we're in an excess reserve regime and we want to go into a reserve deficit, regime, or a scarce reserve regime, that would have a significant impact on the valuation of financial assets. If there was a drain on financial assets, like, for example, raising capital gains taxes or doing a wealth tax, that would also take money out of, it would remove liquidity from the market. So those are the kinds of catalysts that would drive a big repricing event. So when I think about, and this is me primarily looking at things from a market standpoint, because that's where I sit. That to me is a big risk. Okay. And do I think something's going to happen now? No, I don't. But I know I can see that is one source of what could cause a big, say, like market crash. That would also correspond to a drop in output, because you'd have a drop in consumption from the rich, and then you'd have the downstream effect of that. So you would have a really messy reaction.
Wait. So for example, if you have capital gain tax increased, but wouldn't that raise the revenue that the government is collecting, therefore helping their balance sheet?
Yes, this is the government balance sheet. Yeah, so liquidity would flow from the private sector to the public sector.
Public.
Right.
Right.
So it would drain from the market, go to the public sector.
And that's like a reversal of the budget deficit, which means we